So we should understand that how this actually things start spreading, or how the monetary policy transmission takes place. First, step 1, monetary policy committee. Monetary policy committee increase repo rate, right? That is loan rate to banks. So when RBI give loans to the banks, it is now going to be the costlier. Step 2, RBI follows high repo rate. So because it has been ordered by monetary policy committee, so RBI will do that. Step 3, take the example of a bank. Let's say SBI receives high interest loans. Perfect. See, once repo rate increased, everything keeps on increasing. When SBI receives high interest loan, SBI offer high interest loan to customer. That's it. Now, how it is being done, how they determine their specific policy rate, how the home loan is determined, how the car loan is determined, we are going to look that in the future in the coming classes. So this is how the entire monetary policy transmission takes place. Now, what if MPC increases, RBI increases, but SBI does not increases? In that case, yes, sometimes that happen, because SBI may be thinking that if it increase, it might lose the customer. So they will bear the loss because they are getting higher interest loan but not offering it to the customer. So they will bear the loss so that they don't lose the customer. Sometimes it happens. There is not 100% complete transmission of the monetary policy to the last targeted audience. Given this, in present day, RBI determines multiple policy rates. However, MPC determines repo rate. So before coming to the repo rate in detail, that what is repo rate, the short-term repo, long-term repo, and all those things, the variable and the fixed repo, we'll be dealing about the two policy interest rates, that is CRR and SLR. Before that, let's understand what is net demand time liability. Total liability minus total assets, that is net demand and time liability. Now please understand what is demand. Demand here means accounts which are demand deposits, right? Saving account, basically your saving account or your current account. This is your demand liability. See, what is liability? What is the liability of a bank? Liability is something that does not belongs to the bank. This is your money. When you open an account in a bank, the bank, it is your money. You keep your money in the bank as a saving account, as a current account. So this is not bank's money. This is your money. Bank is just keeping it and plus giving you interest for that. So liability is something that does not belongs to you, but you keep it. It belongs to someone else, right? Please don't consider liability as a debt. No, in debt, yes, in debt you have someone else's money, but you don't receive money for that. You pay, right? So debt is something different. That has a purpose, that is taken for a consumption and so on and so forth. So when you put money in your saving account, SBI is not going to buy goods. It's not that the manager in the SBI is going to buy a car from that money. It's not a debt. It's not a loan. You are not offering loan to the bank. No, no, no. It is demand deposits, demand liabilities, because it is on demand. You will go to the money, you will go to the bank and you will withdraw everything. So that is how it is. The second one is, this is demand liability, this is time. Time liability is that which has a fixed duration. I can go to the bank, take my ATM, and I can withdraw money from the saving account. The same is true with the current account. So demand liabilities are those that can be withdrawn even any time of the day, even at night from ATM, you can withdraw money. But there are certain accounts from where you cannot withdraw money, and those are known as time liabilities. They includes fixed deposits. So let's say you have a fixed deposit of 1 year, 7 year, 9 year, 10 year, whatever. So you have kept your money, you have parked your money for a specific period. The second one is recurring account, right? They are also open, recurring deposits. They are also open for a specific purpose. A specific amount of money is being deducted from your salary every month and is being deposited over here, right? You don't have much control over that. And the third one is minimum balance. There are certain banks, if your bank account is not Aadhaar, if your bank account is non-Jan Dhan, right, which is basically no-frill account, but you don't need to keep money in that. Minimum balance is not required. Otherwise, if you open an account in SBI, 1,000 rupee deposit, minimum 1,000 rupee deposit is there. There's a condition of that is there. If you open larger accounts in SDFC, another 25,000 is the minimum balance that you need to keep. So it's like a fixed money. You cannot withdraw that. Now this entire money is known as liability. That is total liability. Now what is total asset? Anything that belongs to bank. If bank has offered a loan to someone, that is bank's money. If bank has offered, let's say, has purchased government securities. If bank has purchased a property. If bank has assets, any kind of assets could be there. So whatever the time is, total liability is there. The bank has someone else's money minus bank's own money. Someone else's money minus bank's own money. Now assuming that it is NDTL is rupee 100. Now please keep this in mind. This is going to be helpful in understanding CRR and SLR. Okay, if you are clear about this, let's move ahead.